Today, we're diving into a really weird puzzle from the world of algorithmic trading. It's a place where you'd think smarter is always better, right? Well, what if I told you a smarter strategy got absolutely crushed by a much simpler one? Let's figure out why.
So think about it. In this high-tech world of complex code and lightning-fast decisions, what if the so-called best strategy is nothing more than a ghost in the machine? A complete statistical illusion? That's the question we're investigating today.
And right here, this is where it gets truly strange. Just look at these results from a backtest. On the left, you have a simple, static model. Its hypothetical profit? $150,000. Not bad. But then look at the complex dynamic model on the right. Only $85,000. The supposedly smarter, more adaptive model got beaten, and beaten badly. So what on earth is going on here?
Okay, to solve this mystery, we've got to start by profiling our two main suspects, the static model and the dynamic model. Let's get to know them a little better. First up, the static model. You can think of this one as the old school veteran. It's rigid, it sets a fixed stop loss that's just a safety net to limit your losses at, let's say, 50 points below the entry price, and it never ever changes it. Its core assumption? That the market's personality, its volatility, is basically stable. Now, is that a brilliant simplification or a fatal flaw? We're about to find out.
And here's our other suspect, the dynamic model. This is the new rookie on the scene. It believes the market is constantly changing, so it uses a clever metric called the average true range, or ATR, which measures recent price swings to set its stop loss. It's designed to be flexible, adaptive, smarter. And yet, it's the one that failed the test, big time.
So how in the world did the simple, rigid veteran beat the complex, adaptive rookie? Well, the answer isn't really in the strategies themselves. It's buried in the hidden evidence. These sneaky statistical biases that can make a terrible strategy look like a work of genius, but only when you're looking in the rearview mirror.
After digging through the data, we found 3 critical clues at the scene of the crime. First, something called optimization bias. Second, a hidden penalty known as lag drag. And third, a common market behavior called mean reversion. And trust me, these 3 clues together are going to crack this case wide open.
And here is the absolute bombshell from the original research. They concluded that the trader behind the static model didn't uncover some profound secret of the market. Nope, they just got incredibly good at identifying the random, meaningless background noise, but only for the specific years they tested.
Our first clue, optimization bias, is actually pretty simple to understand. Imagine your teacher gives you last year's final exam to study. Now, you could learn the material, or you could just memorize the answer key, right? You'd get a perfect score on that specific test, but you wouldn't have learned a thing. Well, that's exactly what the static model did. It found the perfect answer for the past, without any understanding of why it worked.
Okay, next up is lag drag. This is basically the price the dynamic model pays for trying to be so clever. See, it's always looking at recent data to make its decisions. But what happens when the market suddenly goes haywire? The model is still reacting to what happened a few minutes ago, not what's happening right now. It's perpetually one step behind the action.
And our final clue is something called mean reversion. Here's the deal. Most of the time, markets don't really go anywhere. They just chop up and down, bouncing around an average. The static model is a genius in this environment, racking up lots of small wins. But it's a trap, because the moment a huge, powerful trend actually arrives, that model is toast. It is literally designed to get wiped out.
All right, so we've got our clues, and we're pretty sure the static model's amazing performance is a total sham. But a good detective needs proof. So it's time to drag these strategies into the interrogation room and put them through some serious stress tests.
Because this is probably the most important point of all. A strategy's past profit is not a guide to its future. It's a record, not a crystal ball. So we need a way to tell if its success was a genuine edge or just pure dumb luck. We need a lie detector.
So, how do we build this lie detector? Well, it's a 3-part test. First, there's the walk-forward test, which basically asks, does this work on data it has never seen before? Then, the Monte Carlo test, which asks, was this just a lucky sequence of events? And finally, the cross-asset test. Does the core logic hold up in other, completely different markets? So let's just recap that because it's so important. The walk-forward test checks for adaptability to the future, the Monte Carlo test checks for luck, and the cross-asset test checks if the idea is universal or just a one-time fluke. A strategy like our static model, which just memorized the past, is going to fail these tests spectacularly. A truly robust strategy will pass. After putting both models through that intense interrogation, the results are in. It is time to deliver the final verdict. The case is officially closed.
So, what's the verdict? It's a lesson that applies to so much more than just trading. And it's this: profit from the past is not a promise for the future. Say it with me. Past performance does not guarantee future results. It's a record, not a promise.
So now we can say it with absolute certainty. The static model's incredible performance was a complete mirage. It was a statistical illusion. It hadn't found a real signal. It had just perfectly tuned itself to the random noise of one specific period in history. It was the perfect strategy for a world that doesn't exist anymore.
But hold on, because there's one final twist. The solution isn't just to throw the simple model in the trash. The real pro move is to create a hybrid. You keep that simple fixed target, but you make it smarter. You recalculate that fixed number on a rolling basis, say every single week, based on how the market has been behaving lately. This gives you the absolute best of both worlds. You get the precision of the static model with the adaptability of the dynamic one.
And you know, this whole thing isn't just about trading. It's a huge lesson for anyone who builds models with data, whether it's in marketing or medicine or machine learning. So I'll leave you with this question to think about. Is your strategy built for where the world has been or for where it might go next? Thanks for tuning in.